don't think many of you need any introduction to his profile, but I'll still go ahead and give a very short introduction for people who may have joined from outside India and don't know. Mr. Sunil Subramaniam has been the MD and CEO of Sundaram Mutual Fund since 2015, and he also had a long career with Sundaram Mutual Fund before that also. I'll pause over here for a moment. Sunil, if you want to say anything, please go ahead. I may not be able to do justice to your introduction.
No. I don't think that we need to spend too much time on that. Just that, look, I've been in for 40 years in financial services, a couple of decades with the bank, one with the largest public sector bank in India, SBI, another with a global bank, American Express Bank, for another 10 years. And then I joined Sundaram, and then the first 10 years I was roughly doing sales and marketing there. And the next 10 years I migrated from deputy CEO up to the managing director role. So I roughly spent equal time between banking and this. And hence, as a banker, having worked for an MNC bank, I felt that post my retirement, last year I retired in June of 2024. And post my retirement, I've been doing strategic advisory roles with basically the view to helping distributors and investors with all my years of experience to the little bit that I can. So when Ketul approached me, this was something that I said yes to immediately because I think international exposure is something that Indian investors and distributors need as a crying need to add to their offerings. And hence, from that perspective, this is going to be a learning journey, learning for me also over the course of my strategic advisorship, as much as I will add value. So we'll be doing this monthly webinar on the first Saturday of every month. And uh, I will be basically covering today, of course, we'll talk about basics of global diversification, and then Ketil will take you on to more intricacy of the portfolio that he manages. But in future webinars, we will also start covering a little bit about international markets and the general outlook. Okay, so this being the first one, we want to kick started with keeping to the core things. So I think it's also a good time for Ketul to introduce himself to the audience. I'm sure though some of you may know him. Ketul, why don't you do the honors for yourself before I
Perfect.
start?
Perfect. Thanks, Sunil. Yeah, so I am the founder at BayFort Capital. We have been running this firm for about 3.5 years. Prior to BayFort Capital, I was head of equity research for Mahindra Manulife Mutual Fund, right here based out of Mumbai, looking at the domestic Indian mutual fund portfolios of the Mahindra Manulife AMC. I did that for about 2 years. But prior to Mahindra's joining the Mahindras, I was in the US for 20 years, more than half of which 11 years I spent on Wall Street. And out of those 11 years, the last 6 years, I was the global infrastructure fund manager for Franklin Templeton. It was a listed mutual fund, and through that mutual fund, we were investing in listed stocks in 20-25 countries around the world. Now, that gave me very good experience looking at global markets, looking at alpha generating stocks around the world. I did that for about 6.5 years, and all the time while I was the fund manager, we were 4-star rated by Morningstar. So we had a wonderful track record. Prior to Franklin Templeton, I was the founding employee of a hedge fund called Tudor Pickering, and that was a US only long short equity hedge fund, again based out of Wall Street, and I did that for about 4.5 years. So that has been my background, and given that background, when I was working for the Mahindras, I saw this problem where Indian investors did not have access to global portfolios. And that's why we started BayFort Capital with the idea of offering global portfolio solutions to Indian investors. And since then, we have offered only a single portfolio, a global leaders portfolio. And we focus only on that one portfolio. It's a concentrated portfolio, about 20 to 25 stocks. And every investor gets the same portfolio. And the reason, and over here in that portfolio, we focus on only disruptive and innovative companies and stocks, because we don't want to go outside India and invest in the likes of Coke or Pepsi, because those are mature industries, mature sectors, and mature countries. So the growth over there is generally GDP plus or minus 1%. So we don't touch any of that. We only focus on either companies that are disrupting existing industries or companies that are creating new industries, innovative industries and sectors such as AI, robotics, drones, telemedicine, mobile advertising, mobile games, etc. So that has been our focus. It fits a little bit with my and my team's background, because prior to doing my MBA and CFA from the University of Texas. I was a technologist. I worked for Samsung Wireless Laboratories based out of Dallas, Texas for 5.5 years as a researcher. I have a few patents to my name from those days as well. And prior to Samsung, I was the founding employee of a startup called Dynamicsoft, which within 3 years of me joining them, we were sold to Cisco. I was based out of New Jersey. And so that gave me a very good startup tech experience as well. I also have a master's from Rochester, as well as a bachelor's degree in engineering from University of Pune. So, given this background, even the other team members on our team have a similar background with a combination of finance, engineering, science. It gives us a very good view into these sectors, and that's what has helped us select alpha generating stocks in these sectors for the last 3.25 years, 3.5 years now. So I'll pause over here for a moment, and I think Sunil will take over from here for discussion about global investing and global diversification. Sunil, over to you.
Let's take it to the previous slide, the global investing rationale. So I want to talk here a little bit before we go down. So I think that one of the reasons I wanted to do it in this particular way is that I think that the world of global investing from an Indian investor's perspective, that's what we are going to largely, I'm going to cover here, is to look at it from the perspective that, first of all, there has been a strong resistance over a long period of time for Indians to accept global investing, right? And then it all happened in a rush with a lot of mutual funds launching these products. So much so that a limit of $7 billion, I remember it was $3 billion and underutilized. It gradually increased to $7 billion. And in a matter of just a few years, it got rapidly filled up. And then there was a separate 1 billion for passive investing carved out. Even that was almost got filled up. So to the extent that suddenly international investing has caught on to people. But my suspicion is that that's just because of the information technology age, because of Google and everything else that you see on Facebook, and you're seeing the Teslas, the Microsofts run up, and that excitement. Oh, if I had bought an Nvidia, if I had bought. So I think a lot of this is driven by excitement of doing something different and new, and because today there's an information overload. But the focus I want to judge on is yes, those are exciting things, but excitement comes with risks. So the point I want to make is that there is a fundamental logic to investing outside. That's what we are talking about global. And so I want to take you to those basics, right? On why do we at all need to go away from India, which is our home country, right? In that rationale, right? The question arises, of course, is that if India is the fastest growing economy in the world, at 6.5%, we are head and shoulders above China, which is at 4.5% today, and above the US, which is probably at 1 to 2%. So if you are in the fastest growing country, and we all keep saying this, as a mutual fund, I've done this for 20 years, saying in the long run, the nominal GDP of a country will translate into your stock market returns, right? So if India is going to be the fastest growing with a great nominal GDP growth coming in the double digits, stock market should give you double digit returns continuously. So why do I need to go outside when a foreigner is supposed to be looking at India as the best? Well, we all know that this year a huge bucket of cold water has been poured on our head. What is that? Since last September, FIS have actually been taking money out of India. So, number one, despite being the fastest growing economy, we are no longer that attractive to a foreigner to the extent that what they've already invested, they were booking profits and taking it out. What happened there? Why is this fastest growing not trans? And naturally, the act of the FIS pulling money out of India has, luckily for us, coincided with domestic penetration of the mutual fund industry growing tremendously, and DIIs, of which mutual funds are a significant part, getting a lot of SIP inflows, and they have protected our market from a fall. Otherwise, the kind of FIS selling happened, our market should have actually corrected big time. And that then increases the disconnect. Fastest growing economy, worst performing stock market. Even with the selling, buying by the DIIs, India, from an international perspective of the key markets, is been the worst performing market this particular year, whether it's 1 year or YTD. So now that reality, that's what we wanted to say is that regardless of being the fastest growing economy or otherwise, there's a fundamental rationale why global investing must be a part of every investor's portfolio. And every mutual fund distributor has to offer that as an option. Now, before I step into the next slide, one final point here. As I told you, that the limit of mutual funds got rapidly used up. So suddenly, then the whole thing dried up. And then what happened was you had the stockbrokers coming and saying, you can now invest outside India. So people went right from a diversified mutual fund, hopped onto buying individual stocks by themselves. And while some of the party has been great, obviously some others have burnt their fingers there. So then comes this whole thing that there is the third window, which is what Bayfort Capital operates in, called the LRS, the Liberalized Remittance Scheme, under which you're buying those stocks from an End Money or a Zerodha or a Grow or whoever. There you can now do a managed portfolio where you get the benefit of expertise and the benefit of diversification to buying a portfolio of international stocks rather than just going and buying those based on what you have read on the internet. Or somebody says, oh, AI, NVIDIA, it can never fail. Well, that's where the difference is. I'm sure that when Ketul speaks, he'll speak to you about those things. But let me now delve into three solid reasons why global investing is a must. And the first of thus goes to the heart of the problem. If India is doing so well, why should I invest out of India? Well, China is the answer, just as one example. Okay, we can take countries like this, like Japan and others, and demonstrate this point multiple times. But one China will do, because the one thing nobody is going to question is that over a period of the last 2 decades, China has been easily the fastest consistent growing country in the world, and including the fact that, let's take this into the slide. I'm going to read the first line there on the slide saying the Chinese GDP has increased from $1.1 trillion to 17.7 trillion. India is at 4 trillion, my dear friends. So they are significantly ahead. And 2021 itself, they were at 17. Today, they're at about 19 trillion, right? So you have such a strong growth. What is the growth CAGR of the GDP, nominal GDP? 13.5%. And parrot like what I've been saying, over the long run, the stock market should have beaten that. That is 13.5% plus. What did the stock market return in this period? 1.05%. So what is this? This is precisely. Now, am I saying that India is also going to go to a fast growth pace and we are going to get up with 1% return? Not at all. What you need to understand here is that the markets, right, are different from the economy, right? Over a long period, it settles down in that way, generally because stock market companies are the creme de la creme of the economy, and hence any GDP growth they're supposed to capture in their EPS. So, from a pure EPS growth perspective, the Chinese company's EPS would have grown. Well, I don't have the data here. EPS would have grown. But what happens is that stock markets and stocks within there are a commodity, just like commodities. Why I'm saying this is, in addition to the fundamental value, which is what your nominal GDP represents, or for a stock, it's the EPS, forecasted EPS, there is also the demand and supply for the stocks. And what happens is that the growth rate, if it's consistent, it's a given, it comes into the stock price. But the moment there is a choice to an investor of going to another country, where even though the growth may be lower, the prices are even lower, the price aspect comes and takes care of the value aspect. And hence, you have the fact that strong economic growth is not always consistently reflected in strong market growth, because there's a demand and supply for stocks which comes in along with the value of the particular stock and stock market. So, where I'm coming from is now, if you turn your attention to the graph there, you can see that there was periods there, right? We can see that between 2006, around 6 to 8, the stock market boomed. Then there's another period there. You can see it's not that this 1.05% is per year return. There are times when tactically China has the best returns in the world, and times when, after that, during the global financial crisis, Chinese market corrected much more than the rest. And then, as you can see from a zigzag kind of ECG kind of a line there, it's support. And in the last decade, you can see Chinese market after correcting last year, it started perking up. But the long decline was because they went from a high single digit growth to a medium to low single digit growth. So there was, in a sense, a slowing down of their growth, and that reflected. So the point I'm trying to stress is that India is a China plus one in the making, right? Whether that happens in a few years or a decade, it's a China. So the fact is that nobody is questioning the ability of India to remain the fastest growing country for a couple of decades. The point is that growth has been discounted. And whenever there's a disappointment, which happened last year with our GDP suddenly contracting to 5.7, people who have other options. So what happens is that the FIIs, for FIIs, India is a stock and they have an option of entering in Chinese markets or Brazilian markets or Korean markets. So for them, they will always trade the expected growth versus the revision in the expected growth, which is why the Chinese market went through a correction and India also went through a correction last year. Like I said, the correction would have been much deeper if not for DII buying. So I'm not reading any of the other lines, but I think I've made my point that if you are in this world, then if you are in China and you had said, oh, I will invest only in Chinese stock market, you would have been miserably disappointed with a 1% return for a truly long term investor. So the world has changed. It's no longer just about saying buy and hold or, forget like they remember the Hero Honda ads when they launched it, fill it, shut it, forget it. The stock markets are not a fill it, shut it, forget it. You have to be dynamic in terms of allocating to different. And today in India, you are having the opportunity to diversify out of India. So I think I've made the case where why all your eggs should not be in the India basket. We need to place some of them outside. So now if you migrate to the next slide, this tells you, right? Now, what have we compared here from 2013 through to 24? We are talking about various markets returns. And obviously, you all know, right? The green is the best return and the orange is the thing. So if you look at the color coding, you don't need to look at the individual. There are data there of individual returns. But all I wanted to tell you is that you don't get a single country consistently being the leader. The winners keep changing. Market leadership rotates across regions every year. So no single geography consistently outperforms. That's why diversification comes into play. And if you look at the table below there, right, you can see that even within India, year on year, right? Now, if you look at the Nifty itself, you can see the wide variation in its returns, right? 1 year was negative, and then 3 year returns are 14%, 5 year 18%. So the variation in the returns of whether it's Nifty 50 or the Nifty 500. But when you look at now the S&P 500 TR index, right? That is in INR. So I will come to that aspect later. Let's leave that table for the minute. But on this slide, I just want to make the point that when you then say that I will not put all my eggs in the India basket, when you're going to choose which basket to put your eggs in, it's not again choose another country and fill it, shut it, and forget it. It is that you're going to dynamically evolve your portfolio on what? On what is the economy going to grow? Number one. Two, what was the economy expected to grow versus what it is growing? So it may be a high growth, but if a super high growth was expected, which is precisely the point about India. FIIs pulled out money from India last September. What happened? Because they had factored in a certain growth rate of escalating growth for India from a India related 6 related percentage to an 8-10 which China achieved for significant periods of time. And that's why, despite our valuations being higher, they put money. And then when we suddenly surprised them with a slowdown in the GDP, and then Mr. Trump came with his tariff and hurt the long-term growth story. The fact that India is the fastest growing country did not mean anything to the investor because that was there in the price. Now, if there's going to be a disappointment into the rate of growth, he'd rather put his money in a surprising country, which was China this year, which already had dropped, and suddenly there was a stimulus announcement, and yeah, and Chinese market delivered 50% return in that 1 year period when Indian market was just lagging 1%. So where I'm coming from is that this is the dynamic play of economic growth, expected economic growth, and valuations of the stock market. So all of these, and then of course we go down to individual sectors and companies in those countries. So it is a whole new ball game. But if you get expert advice to keep doing that, if you're able to pick a reasonable proportions of the winner countries, and then within the winner countries, the winning sectors, you can outperform. So that's the process that when you say diversification, right? There are two aspects to diversification. Many people who doing the diversification today are only seeking a different profit pool. They want to be in the highest profit pool growth and put all their money in that. That's their idea of it. But diversification has a meaning to it. Diversification is that when you look at your overall portfolio, the fact that you have put your eggs in multiple baskets means that you do lose a bit of return because all of your baskets are not going to be the best performing, but your risk comes down very much. So the reward to risk ratio, which is counted as a Sharpe ratio, trainer ratio, information ratio, there are a whole bunch of these things. But what diversification does is that it gives a little bit of the reward, but manages your risk. So when you're looking at global diversification, my request is whenever you do it, don't look only at the global aspect of it. Look at global plus India and see overall what your return would be. So in evaluating, because otherwise what you'll say, oh, this year India has done well, but that global didn't do well. Perfectly acceptable. But next year, India may not do well and global will do well. Perfectly okay. But that doesn't mean that you look at it in that perspective. You look at global plus India and then look at it because one is compensating for the other. So that's where there's a whole world choice of winning countries which keep changing, and diversification, global diversification helps you to put your money into multiple baskets. So that's one fundamental reason. Next slide I want to do is the India US. Now, why I'm doing this India US correlation is that we said don't put your eggs in one basket. But there is one basket where it can take a larger proportion of your eggs. Okay. Why? Yes, we shouldn't put everything in US, but US deserves a little more than just a reasonable fair share. And why is that? That's because when you diversify, you look at the correlation between two countries. What do I mean by correlation? Again, it's a complicated word. Let me explain this. Right? Uh, there are three types of correlation. There's a positive correlation, a no correlation, and a negative correlation. Right? So what does a positive correlation mean? It means two items, if you put them together, they both go up together, they come down together. That's a positive correlation. Positive means both move in tandem. Right? The next one, I'd go to the other extreme and say negative correlation, which is when this goes up, that comes down perfectly. That's called a 100% negative correlation. Right? You want an example of that? I'll talk about maybe let's look at what do you have? You have an extreme summer and extreme winter, right? Why I'm saying this is if you only two stocks to choose in your portfolio, right? What would you choose? I will just choose one ice cream company and one umbrella company or one woolens company. Let me take woolens because I said winter. I used to give the example of Mumbai, and so umbrellas used to come in. So I chose Delhi today. So what I mean to say is that you know very well that in summers when people go to eat ice creams, so the ice cream profits will go up with the summer stock. And in the winter, people buy woolens to protect them from the cold. So if you had just these two stocks, they would be, in my opinion, reasonably perfectly negatively correlated. And so if you had only these two stocks, your ice cream company would give you profits in the summer and your woolen company would give you profits in the winter. So you'll have a smooth journey, right? So then you should choose as negative a correlation, or if not completely negative, as low a correlation as possible, because two very dramatically different things only make a good combination. So that's what this slide is about, that if you do, and mathematically you can calculate the correlation, right? That's the statistics world. And if you do that, and then you take the Nifty TR, 50 TR, the low correlation part, if you compare that with the S&P 500, what does the last column say? The Nifty, so what is this? Let me explain to you. So you have a column with saying Nifty 50, Nifty 500, Nifty 5-year, S&P 500, NASDAQ, right? So in the first column, you see 100%, that is Nifty with itself. Obviously, there has been 100%, right? The next is, the first column is Nifty and it's 100% with the Nifty 500 TR, right? So Nifty 500 TR has 100% with itself, but a 98% correlated Nifty. Why? 75% of the stocks in the Nifty 500 are large. Hence, the correlation is very high in terms of the performance. Now, next to the next column, the Nifty 5-year benchmark GSEC. This is the bond yields, the debt yields, right? Now, they are obviously 100% correlated with themselves, which you can see in the third point there, but obviously with equities, debt has a very negative correlation. So you only have a 14% correlation. Just to put in perspective, because intuitively we all know, just for your understanding, we all know that equity and debt don't move in tandem. So this clearly makes the point of what is low correlation is a 14%. Now, what does the US with the Nifty 50 or the Nifty 500 is only 25%. So can you understand? So if I may approximate this for your understanding, 26 or 25, depending on the 50 or 50 in the first two parts, percentage of the time, they both move up together or down together. 76% of the time, they don't move together. So that's where US and Indian equities, from that pool of the countries that we showed, right? Regardless of which year's return, next year's return, US stocks and India stocks make a very good complementarity. So when you're choosing countries, like I said, in the diversification, one of the rules to choose the country in which you will go and tackle is to look at it from, is it negatively correlated with India? Whereas some near-term markets like Bangladesh, because Bangladesh is export driven and we are also trying to grow, could be that when those things help them, they are highly correlated. So choose something as different, and the US stock market today is very low correlated with the market. So one reason, one methodology to choose. Similarly, for each country, when we evaluate it, right, we will look at the correlation also, right? When BayFort does a choice of stocks and correct, this will be an important input. So I hope they've made the point on when you diversify, how you diversify. Next slide, please. So in this slide, what I want to say about the US is that that's the single country risk that we mentioned in terms of a good growing economy and a good growing stock market to some extent doesn't hold good for US, because the US stock market contains a significant number of companies which don't depend on US economic growth. Probably in the rare countries, if you take in India, it will be like 90% or 95% plus that Indian companies, except for the export-oriented IT or pharma space, right, and you know that exports to GDP India is very, very low. So if you take America, it tells you that of the S&P 500, that's 500 companies in the US, listed in the US stock market, only 52% of that sales comes from America mainland, which means 48% of the sales comes from the rest of the world. The proportions are given in that graph, but what the proportions are not relevant. The point is that the US stock market gives you a diversified economic performance of multiple geographies. It's reflected in the price in the US stock market. So when I said Chinese market didn't deliver, in the US market, this is one of the reasons that despite a low economic growth in the US, the US stock market has been roaring. Because those companies are not just dependent on US inflation and US employment and US everything, they are selling. And examples, right? Take companies, Apple. Apple's sales comes from China and India. Take Microsoft, take any big global corporation, McDonald's, Coke, Pepsi. They don't get most of their sales, 30%, 40%, 50%, varies from company to company, comes from the US. The rest of it comes from geographies. So depending on how those economies are doing, their sales goes up, their profits go up or down, and that's what gets reflected in the US stock market. So this is the second reason why US should form a reasonably high proportion of your global non-India diversification. That is the point I wanted to make, that US, you cannot ignore. And ultimately, from an economic share perspective, US is 30% of the world's GDP, right? But it's 70% of the world's stock market. It varies from 60 to 70. But why I'm saying this is, so this tells you, while the US economy itself may not be a great place to be in, the US stock market is a great place to be in, because they derive their sales from a lot part of the world. So I think I made a case for having the US as I would call it, a core component. The percentage component, of course, can vary based on thought processes, but a core component of your portfolio. So that's the second point I wanted to bring through, is when you look at a country, now you take China, for example, how much is the Chinese stock market companies dependent on China versus exports? Because China, as you know, is the world's export powerhouse. So similar study on China could also reveal that Chinese stock market growth may not necessarily be fully linked only to China's economic growth, but on their export story and dependence on the rest of the world. So we can go down for each country like that, but I just wanted to make that brief point with this particular slide. Now, if you move to the next one, comes this point. Can I just go back to the previous slide? I am going to talk about currency, but I don't want these data there to be there. So don't ignore the slide. All I wanted was you to hear me and not see the slide, right? Now, being in India, there's a huge, huge advantage to global diversification, which is what? Which is the fact that fundamentally, now we all know, right? We've talked about fundamental nominal GDP growth. We talked about, we know that fundamentally we talk about EPS, cash flow forecast, discounted cash flow as a technique, right? Every commodity except for gold, which has no much of industrial use, maybe about 18, 11 or 12%, I think, of gold is industrial use. Rest of it is just demand and supply. Every other commodity, right, has a fundamental way in which it's calculated. So if you take copper, it is a cost of producing that copper, right? And then there's a demand element to the copper and the prices come in and everything, right? So why I'm pointing this out is that currency is also a commodity. Like I mentioned, the stock market being a commodity, currency is also a commodity. So any commodity comes, there are two factors at play. There's a value and there's a price. Price is divided by demand and supply. Value is divided by the cost of production. That is the factor cost of production, labor, land, capital, all of that deserves a return. And that's what the value of a particular commodity or a particular stock or anything like that is. That. So why I'm trying to say is there's a fundamental way that currency's value comes in. And the first thing to note that except for the US dollar, every other currency, there is no standalone value for a currency. A currency gets value only in comparison. So first thing to do is, unlike other commodities, currency is a comparative commodity. There's no standalone value, right? So you have to compare with something to get its true value, right? So currency in India, let's say we compare with the US dollar. Why? Because the US dollar is the dominant currency across the world still. The gold is making a strong pitch to be the alternate based on recent developments. But let's, for the time being, look at the fact that the dollar. Now, so what is the fundamental way in which the value of the rupee is calculated? The price of the rupee, that's the actual quote that is there for the INR, is determined by supply and demand. FII flows come in, there's demand for the rupee. FII flows go out, there's demand for the dollar, right? Obviously. So demand and supply. Exports go up, there's inflow of dollars comes in. Imports go up, there's need for that. So demand and supply has got multiple factors which decides the short-term movement of currency. But the medium-term movement of is again something linked to more fundamentals rather than demand and supply. And what is that fundamental? The fundamental way that a currency's rate vis-a-vis another country is calculated is by a formula called PPP. What is PPP? Purchasing power parity, which means what? It means that the difference in inflation between two countries tells you that the country with the higher inflation, its currency must weaken against the country with the lower inflation. This is the fundamental law. And by how much should it weaken? By the difference in the inflation. Okay, this is the fundamental factor. Now, unfortunately, we don't have comparable commodities on inflation to decide this unilaterally. Which commodity is inflation you pick up? Because the CPI basket in India is very different from the CPI basket in America, right? So while this is the fundamental way it's calculated, and I'll tell you, when I did my MBA, and I'm sure Ketul also shared that in MBA, the way our teachers used to tell us about this was to call it the MAC index. They said the one product, and topically this is American MBA driven, the one product which is sold everywhere in the world, according to them, is the McDonald's burger. So you can choose the McDonald's burger's price in each country and say, this is the difference. And they actually took that and explained to us currency with that. That's how I was taught currency, saying a Big Mac costs this much in London, this much in US, this much in India, and then that difference in cost will tell you what's the difference in inflation. That was a very crude logic, but the world cannot depend on stuff like this, right? So the way the world then calculates the fundamental value of currency is through a slightly suboptimal formula, not PPP, but IRP. What is IRP? It is interest rate parity, right? Why? Because inflation is a combination of real inflation plus nominal inflation, right? So the nominal real plus in the cost, sorry, when I say interest rate, sorry, I rephrase my words. Interest rates, interest rate parity, interest rates have a real component and a inflation component. So which gives you the nominal GDP. So because interest rates capture the inflation rate in them, and because interest rates are quoted everywhere at the top, you can get this and it changes by the second, and it's perfectly what you call symmetrical, perfectly reliable, transparent. Nobody can manipulate them. Interest rates are used as a substitute. By who? By the main people who trade in this commodity called currency, the bankers, the treasuries of the banks around the world. And believe me, their stock market trading volumes are a rounding of error in the currency trading volumes of the world. Right? It's I don't know, this is a million times more or a trillion times more, whatever. So why I'm saying this is that price discovery happens like that. So what is this? Why is this interest rate parity used? Because interest rates are a proxy for inflation, so it's easy to calculate. Second thing they do in this is they remove away the default risk. When you come to the real interest rates, there is a default risk, right? You have a triple A versus a triple B, you know that the interest rates will be different, right? So you must compare comparables. So everybody uses the government of that country's borrowing rate because the government will not default. Why will the government not default? Because they can always print more money to pay their dues. When they print more money, it comes into inflation. So that gets taken care of. So generally, you compare the currency. So why I'm saying this is that's the way bankers use the interest rate predicted movements of each country, and then you trade that into the currency part. That's the fundamental way decided. Cut a very long story now short. So what? Just like the PPP rule that I explained, the interest parity rule says that the default free interest rate between two countries, which is the government's borrowing rates, whichever country is got a higher interest rate, proxy for higher inflation, its currency must weaken. By how much? By the difference, because all other things being equal, the difference in the interest rates is a proxy for the difference in the inflation. So that's the fundamental rule. So why I'm saying this is the US interest rates and Indian interest rates, despite the fact the US interest rates have spiked up from a 2% levels to the 4% levels, India's interest rates are still at 6.5. So if you take the latest Fed cut and still take a 4% as just for the calculation purposes as a US risk-free borrowing rate, and India's at 6.5 for approximation, and the exact will vary, it means there's a 2.5% today prevailing interest rate differential. If nothing else changes, the fundamental laws of currency say that the Indian currency must weaken by 2.5% every year. Now, when can this change? By two reasons. One is that if this interest rate trend is going to change, if the Fed is cutting rates, but India is not cutting rates, if 4 goes to 375, the differential goes to 275, then the pressure on the rupee to depreciate. Unless the RBI also follows suit and cuts it and keeps the difference the same. So one thing which changes the currency's depreciation rate is how the country's interest rates are expected to move. Number one. Number two, back to square one, demand and supply. Ultimately, 2.5% is the difference. But if exports are falling for India and imports are rising, the demand for the rise, the depreciation will be even more. Right? So, why I wanted to anchor this discussion is that being in India, I don't foresee a date in the very near future or even the medium term future where Indian interest rates are going to be lower than American interest rates. Because end of the day, you might talk America is running 125% of GDP, debt, GDP, $1 trillion deficits, and somebody downgraded them. We ought to accept that the US is a far stronger economic country than India. That's why we are nowhere near being a triple A, whereas one notch below triple A, you're getting panicky about America. So the fact is that Indian interest rates to be cheaper than America means India must be a stronger fiscal country, right, than America, right? Which I think is some way off. We can always aspire to it as part of Viksit Bharat to say that will we become better? God knows. In 10, 50 years, things can change. Yes, I'm not getting into that. But the fact of the matter is that for the foreseeable future and for the past, whatever, 40, 50, 100, 200 years, rupee has always weakened versus the dollar the amount of depreciation. And sometimes it has strengthened when huge FII flows have come in, or RBI, went and bought, the swap they did when Raghuram Rajan did. He brought a huge amount of dollars suddenly into India. So demand and supply will lead to short periods of rupee appreciation. I'm not denying that. But fundamentally, because ultimately when you go into the stock market to invest, you're using fundamentals, you're not using technicals to build a long term portfolio. A trader can use technicals, a currency trader can use technicals. But you are not here, my dear friends, as somebody who wants to trade in global stocks to make quick money and then get out and get in. I assume that is the case. So, with that context in mind, from a fundamental perspective, India represents a brilliant opportunity for you to add to the returns from your diversification, from choosing the best performing stock market. On top of the return of that market in their local currency, your most likely your returns will be enhanced by the rupee depreciation. So if there's anybody in this country who has to celebrate rupee depreciation, it has got to be global investors from India, right? So that's a very powerful thing. And for the foreseeable future, it's going to be there. This year, for example, has been a bad year for the rupee, but a good year for global investors because almost 4 to 5% the rupee has weakened. So which means you've got that layer of, I may say, what do I say? The froth on the lassi for you from the rupees weakening. So the next slide now, having given a very reasonably long explanation, precisely tries to show you that USD appreciation typically has enhanced in INR returns by 3.5% annually. Today, the difference is only 2.5 for 275, but historically it's been 3.5%. And you look at the table up there, you can clearly see that the last line, INR USD. So there are times when it's been 3%, sometimes it's been 13%, sometimes it's been 11, sometimes in negative 5.9. So clearly, currency is a function of demand and supply. So, in terms of investing in another country, right, whether you should take short term currency expected moves into account on this, I would suggest no, because your main job here is to buy the companies in the country where the growth is good. How the rupee weaks, the best of bankers, and I've spent 2 decades in banking, haven't predicted currency. So, predicting currency is almost like a lottery. So you just go by the fundamental factors. In one particular year, the rupee may end up appreciating, and you will feel that, oh, my global portfolio has returned less than it should have. Yes, but that's part of the game. It will happen. But by and large, for an Indian investor, currency depreciation is one of the biggest tailwinds to his returns from an international stock portfolio. Right. So I hope I made the currency point in good measure. And we move to the next slide now, which is the summary slide from my end before I hand over to Ketul. Is just to summarize this global investing rationale. So I spoke about diversification, protecting the portfolio, and boosting returns. Both happen. Markets don't move in perfect sync. When one region lags, another may lead, helps reduce volatility and create a smoother long-term return path. Second, earlier, global investment options were able to UHNIs through their global advisors, those who had multiple, maybe they had citizenship with other countries, maybe they had, so their global advisors. Now HNIs are able to. Why? Because of the LRS scheme, right? Third is that innovation sector participation cannot happen if you have an India oriented portfolio, because innovation sector stocks are only listed globally. So one of the powerful reasons for doing global diversification, if you want to participate in this new innovation that's changing the world, right? You have to have a global portfolio to be able to take advantage. Fine. And the second, of course, that access to growth opportunities worldwide, different pockets have different growth prospects, and the diverse growth drivers can be captured. And finally, to summarize, as we said, hedge against the rupees depreciation. So I hope I made the global investing rationale case in good measure. I'll now hand over to Ketul to take over, to go down from this whole macro 20,000 feet high level the perspective that I've given to a more micro perspective. I hope you enjoyed it. I will stay back here, and at the end we'll have a Q&A session. Please feel free to post your questions on the chat box, and we'll do our best to attend to that. Over to you, Ketul.
Thank you, Sunil, very much. Thanks a lot for the wonderful explanation. I think I don't need to say anything more. Sunil has explained it very well about why global diversification is very important. I just want to make sure that participants, if you have any questions so far, please go ahead and type it on your chat box, the Q&A segment of this call. At the end, Shrestha or Suman, who is one of our panelists, they will be able to ask those questions on your behalf, and either Sunil or myself, we will answer those questions. So please go ahead and type those questions so that they are there in our list and we will answer them. Now, moving on to the next part. As Sunil very rightly described, that US forms a large part of the total market cap of the global stock market. It's about 50 to 60% at any given time. So the natural question we get that is, okay, if we diversify, what about the US economy? If it is going to do well, not going to do well over the next few years. Now, obviously, just like any economy, there will be a bull thesis, there will be a bear thesis. As long as the positives outweigh the negatives, we are in favor of investing, because in our experience in global investing, there hasn't been a single country ever where there are only positives and no negatives. Every country you go to, you will see both the sides. So let's go with the negative news first. Inflation from higher tariffs, obviously, that's already been the talk of the town for quite some time. So a lot of that is already built into the stock prices. So we understand that that's a negative. Net new job creation is declining in the US, especially from the government sector layoffs recently. I think that is likely to continue to increase. That's a negative. Impact of the US government shutdown. Yes, that is a pushback that we get, which we'll discuss why that is not a problem. And then finally, we get a lot of pushback on valuations. Is AI in a bubble? So we'll discuss that also. That is a negative, but not to the extent that the media is projecting it. When media says that AI is in a bubble, they are talking about specific 50 stocks, but US is made up of more than 5,000 stocks. So obviously, a small minority cannot dictate the entire narrative, which it does in the media, because that's what media is supposed to do. But we will discuss that also. On the bull side, while we see the bear part of the thesis, on the bull side, there is a monetary stimulus that we saw a rate cut last week, and then we saw another rate cut a month back. And we think there will be a 25 basis point rate cuts for the foreseeable future in every Fed meeting for the next 4 to 6 months. And so that is a huge stimulus to the stock markets, which we think is a tailwind to the US stock market. So we'll discuss that. Another one is the fiscal stimulus, which is coming from the tax cuts announced by the One Big Beautiful Tax Act, which was passed in the earlier part of the year by President Trump. So you put those two together, you have the government as well as the Reserve Bank being a tailwind to the stock markets. Of course, EPS growth is always important, which is positive and in double digits for CY26. So we put all of this together, and the positives outweigh the negatives. And that's why we still feel that US is a good place to invest as of now. Let's go into those individual things that we discussed. Well, what is the US shutdown impact in the near term? Because we expect that the shutdown will end anytime in the next 1 to 2 months. It cannot go on longer, because slowly and steadily, individual US government services are shutting down, which is not something that can be sustained. So we looked at what has happened in the past during US shutdowns. So during all the shutdowns in the past, there has been rarely a few incidences where from the first day of the shutdown to the last day of the shutdown, the stock market returns were negative. Most of them, you see, they are positive, including the last shutdown, which lasted for 35 days. And the returns during those 35 days was a plus 10% for the S&P 500. So at least history shows that the markets are not too worried about the US government shutdowns, because there is less uncertainty over there. Markets get worried with uncertainty. In this case, there is a certainty that within 20, 30, 50, 60 days, the US government is going to start functioning again. And so there is a finite limit to what things can go wrong. And based on that, the market doesn't care too much about the US government shutdown. Consequently, we don't factor that in as a big part of our decision making because that is mostly immaterial in the mid to long term. In the short term, there might be some media chatter about it and it may impact the sentiment slightly, but history shows that overall, from the first day to the last day of the US government shutdown, the negatives have, the returns, I beg your pardon, have been mostly positive for the markets. The other pushback we get is obviously, is AI in a bubble and is our valuations too high? So now AI has become so broad that AI is not one single sector. Within AI, you have the hardware, and within hardware, you have networking hardware, you have compute, you have memory, then you have servers, you have edge devices. Edge devices are devices which are that we use like computers or cell phones. Those are edge devices because they operate on the edge of the network. And then there's the server side, which is mostly what you hear when you hear NVIDIA. NVIDIA is very prevalent on the server side where a lot of the AI processing is happening right now. So it has, first of all, within hardware, it is diversified into multiple subsectors. Next comes software. Then you have software which is enterprise layer. You have software that is, you have databases over there. You have workflow software. You have pure enterprise user software, UI software. And then you have the consumer software. So we haven't even reached the consumer software part of AI as yet. We are still, the companies that we are investing in, they are mostly available only in the hardware side. And just like any technology revolution, it always starts with hardware because unless you have the hardware, you are not going to use the software. You need a PC to use Microsoft Windows. You need a PC to use Google Chrome or any application. You need an iPhone to use any application on it, to use Google Maps, to use Facebook, WhatsApp, right? So the first revenue generation is typically done at the hardware layer. And now some parts within hardware, we do feel that they are slightly frothy in terms of valuation. And obviously it is our job to navigate that and we get out of them. But even within hardware, the edge devices have not gotten a lot of valuation premium that it deserves, which it will slowly get, but so far they have not received it. First, it was compute, which means chips that process information. Those were the first ones to get the valuation premium. Next, it was followed by networking. Then it was followed by memory. And in our portfolio, we have progressively followed that path. We first invested in compute, then we invested in networking, then we invested now in memory. Memory is the last phase within networking where we see that we are going to get a valuation premium. After memory, it will most likely move on to the enterprise software databases. Databases is now starting to get a little bit more valuation premium compared to other software. So I think that is how it progresses, and that is how it is progressing. We have seen this movie two times during the mobile telephony revolution as well as the internet revolution in the past. And so this is no different. It is moving exactly according to the script. And we do see that transition from hardware to software to enterprise software to consumer software. So now we have slowly started seeing a few consumer software companies also getting the benefit of valuation, and because they are likely to generate higher revenues from AI applications. So we are seeing that also. But that is where AI is. And when the media talks about the AI bubble, they are talking about the probably 50 companies that are in the hardware space, that a lot of them may not have any revenue, but the expected revenue is supposed to be very high because hardware has been in that AI premium valuation phase for about 2 years now, since ChatGPT was introduced. So that is where there is some froth, and you can call it a bubble. But the rest of the market, we don't believe there is a bubble. And AI is a very broad market now. It has evolved from just hardware to a very broad market, and that's why we don't see a bubble. And overall, at the index level, also S&P 500 or even the Nasdaq, they are nowhere close to bubble levels. For example, in the tech bubble in the year 2000, Nasdaq went to a P ratio of above 150. Right now, it's in the 30s. So you are far away from a bubble. We are not too worried about a bubble in these stocks. Moving on to US stock valuations, I think this is a chart, a scatter plot of the US returns for the next 12 months and the PE ratio of the last 12 months of S&P 500. And you can see it is all over the place. There is no R square. R square being negative means there is no correlation between the historical PE ratio and the next 12-month returns. So from a statistic perspective, while from a fundamental perspective, you may feel that when the market has been expensive in the last 12 months, the next 12 months, the market should not do well. Statistically, if you go back all the way to 1975, that has not been the case. The chart very clearly shows that with a R squared of minus 0.01. So I would not be too worried about the valuation of the last 12 months for the returns of the next 12 months. Now, what are the things that then will matter is some of the things that we are discussing over here. Again, this is the US stock valuation. Last point I'll make over here. The 5-year valuation that you see at the bottom of this chart over here, and the 5-year and the 10-year average, and the fourth bar chart from the right-hand side is the S&P 500. You will see that the current valuations are pretty close to historical. They may be 10-15% above historical 5-year and 10-year averages. But the reason for that is that the growth that we are seeing for CY25 and CY26 is much higher than the historical growth that we have seen. Historically, when you think about the S&P 500, you think about 5 to 7% growth. But for 2025, calendar 25, we are expecting a 10.6% growth for S&P 500, and into the almost mid-teens with CY26, we are expecting a 13.4% growth in the S&P 500 earnings. So your growth is roughly double of historical growth expectations. And so if you're paying a slight premium, 15-20% premium on the forward PE multiple of the S&P 500, it is not unwarranted. It's not cheap, but it's not bubble or expensive also. I would say that is fair valuation territory. So that's why we are not too worried about the valuation either, right? So once you are not too worried about the valuation, what are the other things that we discussed? The monetary stimulus, which is the rate cuts that are happening. If you see on the chart on the right-hand side, in the non-recessionary times, which is the green periods, there is not a single incidence when the Fed cut interest rates. That is the chart on the right-hand side shows the return of the S&P 500 12 months after the first Fed rate cut, historically speaking. And the green ones are the ones when the US market or the US economy was not in a recession. So in a non-recessionary phase, whenever the Fed has cut interest rates, there is not a single instance in the history of US stock markets where the next 12-month returns were negative. And that is one of the big reasons where for the last 4 to 6 months, since the market started building up expectations of continuous Fed rate cuts, any bad news in the US markets, the markets takes it in a stride. The market will be down for 1 day, 2 days, sometimes a week, but then it continues its march upwards because of this dynamic to quite an extent that whenever the Fed cuts interest rates in the US, it is one of the best times historically to invest in the US markets. And the Fed just started cutting interest rates last month again. And so for the next few months, we are in a Goldilocks scenario, if you will, in the markets. The other thing is the tax cuts that the One Big Beautiful Act allowed from the beginning of the year. Just to give you a comparative idea about how big these tax cuts were. For example, Google generates about $75 billion of cash flow every year. From the first year of OBBA tax cut, the additional cash flow that Google will generate is about $25 billion. And so from the first year of the tax cut, Google is going to get additional 33% of their annual cash flows. And you saw that with their earnings announcements. I think the stock was up into low double digits or 8 to 10% after their earnings last week. That was because the market is not worried about them increasing their capex by $1 to $2 billion because their cash flows are going to increase by $25 billion just from the tax cuts. And this is happening not only for Google, but for all the companies who have some sort of R&D expense, because R&D expense in the past, they were writing it off from their taxes paid over 5 to 15 years. With OBBA, they can write it off in the very first year. So the tax benefit that you get from that is about 20 to 30% of your total cash flows, depending on the company. And that's a big boost to the stock markets as well. So you put these three things together. One is reasonable valuations, two, the Fed cutting interest rates, and three, the US government pushing the markets higher with tax cuts and increasing the earnings of these companies by providing tax cuts. You put all of these three together, and it is a perfect time to invest in the US markets, because rarely do you see such large tailwinds helping the markets all at the same time. And so we are very confident and very bullish about the US markets also. Then you get to the next question is, okay, so we agree that we can invest in the US markets. What are the sectors that that you should invest for the next 12 months? So this is a chart of how various sectors have done during the last rate cut cycles, and those cycles are in the first column that you see over there. There have been multiple rate cut cycles going all the way back to 1974 is what we are showing over here. And in each one of those cycles, which were the sectors and how did they do within the S&P 500? So right in the center, you will see consumer discretionary, which has been the best performing sector during all the rate cut cycles, with an average return of about 26% and a median return of 25.6%. So not median and average is not very far. And this sector has outperformed 75% of the times the broader S&P 500 index during rate cut cycles. So obviously the expectation is that there could be a similar behavior this year also. So we have seen a lot of consumer discretionary high beta stocks moving higher in the last 3 to 6 months. And some of the other sectors that are also expected to do well are information technology, financials, you have real estate. So all sorts of companies are expected to do well for the next 12 months. But this chart gives you an idea about what are some of the best sectors in terms of performance for the next 12 months. These are some of the sectors that we are investing in. I will not go into a lot of detail. I will quickly glance through the slides. We have already crossed the 1 hour mark. I want to give some time to Q&A also, but we do like mobile gaming. Similarly, we are also investing in quick commerce. We do like that segment as well. If you have any particular questions, feel free to post about these sectors and I will go into the details. But otherwise, I'm quickly glancing through the slides. Telehealth is another space where you must have noticed the health expenditures in your own city, country, town have gone through the roof post-COVID. The same is happening worldwide. Telehealth is one of the best ways to reduce those expenses, the hospitalization expenses, medical expenses. And so we are very bullish about that segment as well. We have a couple of investments in that space. These are some of the sectoral growth themes and expected growth that we are seeing for the next 5 to 10 years. You can go over that again. If you have any particular questions, I will be more than happy to answer them. But we are seeing good growth in all of these segments worldwide. These are some of the case studies that we have. This is an Israeli company. The founders came out of the Israeli military, and they are using their hyperspectral analysis technology that they developed in the Israeli military for consumer applications. So we are looking for such companies around the globe. I will not go much into the details. You can go through the slides at your own ease, but these are the type of companies that we are looking for around the world. C Limited is e-commerce, digital payments, quick commerce, as well as online payment, BNPL type of company. We are also very bullish in a lot of these companies. So these are some case studies that we have over here. I will pause over here and we will move on to the Q&A since we have crossed the 1 hour mark. I want to give some time to the questions. Suman or Shrishta, if you don't mind, could you please go through the questions on the Q&A box? And participants, please type your questions in the Q&A box and we will be able to answer them fairly quickly.
Hello.
Yes, go ahead, Suman.
Sure, sir. So there are a few questions that we have received our panelists today. So one query they have asked us, what risk should investor consider when they are investing in sectors like AI, EV companies abroad?
Sorry, I did not get the full question. What should they consider? What is the part that you are
So
asking?
what kind of risk, should investor consider when they are investing in such sectors like AI, EVs abroad?
What kind of trends you mean to say?
What kind of risk investor, like for how long they should be investing?
Okay, okay. So yeah, a good way to think, and this is how we think. They, we talk about Warren Buffett's Coca-Cola investment, but he invested in the 1970s, right? So it would be wonderful if we could go back to the 1970s and invest in Coca-Cola and ride their growth through 2020, right? But that is not an option we have. So we do feel that we should select sectors like the Coca-Cola of 1975, where Coca-Cola was going around the world and they were, introducing their products to different countries around the world and making money and growing. So we are looking for the Coca-Cola of 1975, right? And so you should obviously be looking for the same thing. Today, what we are looking at are some of these sectors like drones, robotics, AI. These sectors were not there 5 to 10 years back. But just like Coca-Cola grew from 1975 onwards and now is very matured, these sectors are in the 1975 phase of their own industry and they are going to grow bigger because AI, there is no option out there. We are going to use AI one way or the other. Some people may use it 1 year down the line, some people may use it 5 years down the line. The only question is when you are going to use it. It's not a question of if you are going to use it. So if you think that we are in the 1975 of the AI phase, then for the next 20 years, you definitely want to be invested. So it is not a 1 year time frame. Now, some stocks may get into the bubble type of valuation that we discussed. But overall, as a sector, it is going to continue to impact your lives and grow over the next 10 to 15 years. So you should be invested with a long-term horizon, not with a short-term horizon. So I'll pause over there. Suman, next question.
Yeah, so the next question is recently, like in past years, foreign market has, been rallied so goodly. So there isn't any chance for any correction, or you expect that there will be some correction going to happen, or this will be a good time to invest in international market. And which one would be like much suitable for now? Is it like domestic one or international?
So I will address the correction part, and Sunil, you may want to add something to compare. But my point is that because there is a lot of tailwind, what we discussed in terms of fiscal stimulus, monetary stimulus, and the tax cuts, what we have seen that anytime the market declines or takes a pause in the last 4 to 6 months, the very next week it goes back up. So right now there is a lot of positive momentum. And so even if there is a correction, it does not last for a long time. So I think that will continue for the foreseeable future for the next uh, 1 to 2 years, I would say. Does that mean there won't be a 10% correction? No, absolutely not. There could be a 5-10% correction anytime. These are the markets. But because of these tailwinds, those corrections have been reversed fairly quickly. That's what we have seen over the last few months also. And so that's what we are expecting over the next at least 1 to 2 years. So we think this is a good time as any to invest in the global markets. Sunil, do you want to add anything with
Yeah,
respect
so
to?
basically, see, from an Indian perspective, is the issue is that you're already exposed to India. So nobody's telling you to take your money out of India and put it in global markets, right? It's only about whether you're going to put 95% of your money in India, 90% of your money in India, or 85% of your money in India, right? So you're talking about a tail of your portfolio in terms of the quantum of your allocation, but which could be much higher in terms of contribution to the profits. For the reason that, very simply speaking, right, FIIs are the ones who have made Indian market not deliver good returns, right? Now, if FIIs have to come back to India, then obviously that can happen only if there is a rate stimulus in the US and FIIs get more money in their hands and they get the rate cuts there, help them to access cheaper money because a lot of the money that FIIs put in is leveraged capital. Remember that. They borrow money on the back of what they have from the banking system and then put it outside. So a soft interest rate scenario in the US, right, helps money flow, liquidity, and liquidity like water knows no levels, it doesn't differentiate. So a portion of it will go into US markets, a portion of it will go into emerging countries, a portion of that emerging country will come to India. So obviously, India specific, there's a big tariff overhang which has been hurting. And once that gets solved, there will be a favorable outlook to India. So anyway, like I said, you are going to benefit from that India market. The point is that at the points in time, and these need not be years on end, it could be that monthly returns itself, you could find that some foreign market growing more than an Indian market. So the beauty of diversification is that to some extent, it is that I don't know how to predict the future. So I am putting my eggs in multiple baskets. So today, there is no reason to be despondent about global and say only India is going to be the shining star. And so 100% of my portfolio is in India. No, the fate of Indian market and the fate of global markets are as uncertain and dependent on multiple global factors. And today, thanks to an interconnected world, right, liquidity flows across the world in terms of stock markets especially flow freely. So you could have a month where India does the best performance, and you could have months where global outbeats India. So to stay diversified and based on your risk appetite, you choose whether you're 95% in India or 90 in India or 85 in India.
Perfect. Thanks, Sunil. Suman, you can go ahead with the next question, please.
Sure, sir. So another attendees is asking, so Gift City, if they invest, so that investments are being offered tax-free, but which is not the same case with BayFort. So would you like to add any comment on that?
So I think Sunil may also have some view on this, but I will talk about outbound investments. See, Gift City was made for inbound investments. Gift City, so for people from outside India to invest in India, and they are outside of the Indian tax net because Gift City is considered to be a foreign jurisdiction. So if you are investing into India from outside, then you don't pay Indian taxes. That is where you get the benefit. If you are investing outside of India, there is no benefit in terms of taxes of investing through Gift City because if you're an Indian resident, whether you invest through Gift City or not, you still have to file the taxes and income the same way that you would do in both the options, and the same taxes apply. There is no benefit in terms of investing for outbound investments. When you are investing from India to outside India, there is no tax benefit. The taxes remain the same. Sunil, you want to add anything?
Yeah. I noticed that the question has come from one Mr. Rajaram. Now, the only thing is that it applies probably if he's an NRI and he's then looking at investing in India. But BayFort is meant for people investing internationally. So if you're an NRI, you can invest in BayFort's portfolio from outside India and there is no tax impact. So absolutely. So you're free to invest in a BayFort portfolio. You don't need to come to India, bring your money into India, or if you want the Indian market, like Ketul explained, the gift city is a tax-free option. For outside India, the gift city is only a vehicle. And I'll tell you where the gift city is important for Indian things, and that's only a technical process. That is that the reason Bayfort Capital is able to take money is because it operates under the LRS scheme. So an Indian company like a mutual fund or a PMS can launch an LRS-based gift city investment, but it makes no difference to the customer whether it is the mutual fund doing a gift city based outside investment or investing directly through Bayfort outside India. So I think that's the key point. Gift city is a tax free option, like Ketul mentioned, for outsiders to invest in India. But for Indians outside, Gift City probably gives you a pooled structure for an Indian to invest outside if a mutual fund chooses to launch through Gift City, but still the same LRS gap. So mutual funds may do it because their limits are full under a regular mutual fund. They can go overseas and use the LRS. But there again, the key issue is then you have to then choose. Whereas Bayfort is very clear about what they are doing with the portfolio in terms of the international stocks. So to that extent, the expertise that Bayfort carries of studying these stocks and Ketul's to multiple decadal experience in America and tracking global is the real value add here. Whereas an Indian mutual fund, when he goes to and launches a gift city product outside India, how is he going to choose those stocks outside India? What skill set does he carry sitting in India? Which means he has to tie up with a partner outside and invest his funds either as a fund of fund into the foreign fund or tie up with a partner, to which there will be additional costs of that partner. Then there's a double layer of cost between one cost here and a fund of fund cost of the underlying fund there. So I would suggest that, if you're an Indian resident, then BayFort represents a better option to you because of the sheer expertise and the clarity around where their portfolio is going to be invested. So you believe in that theme that they are investing, then BayFort is the best option.
Go ahead, Suman. Next question, please.
Yeah, so again from Mr. Rajaram, we have received another question that are we bullish on quantum computing like investing into?
Fair enough. See, let me compare it to AI. AI was called machine learning till ChatGPT came along. Machine learning was there for the last 10 years. Very few people were invested in machine learning because we could not see a clear revenue application or use case in the near term. That's why people were not investing in machine learning. But when ChatGPT came along, people could see the revenue generation potential of ChatGPT. And then all of a sudden, machine learning got converted into AI and it became a large sector to invest in. So quantum computing is still in the machine learning phase. We don't see an immediate revenue generating opportunity over there. The day people will see that revenue generating opportunity, that is the day it will become as big as AI. Now, could that happen 2 years from now, 5 years from now, or 10 years from now? That is the only question. And we are also waiting on that. We typically don't invest till we get the chat GPT moment. So we may lose the first 10, 15, 20%, 30% of the returns because we are not waiting for 5 years. That's the price we are paying for not waiting for 5 years. If we had invested in machine learning, we would have waited for 10 years before machine learning became chat GPT and was called AI. So it's okay to pay that 15, 20% premium and then invest in a sector when you see clear revenue generating opportunities or even potential for that. And so that is why we do follow quantum computing. We understand it very well, but so far we are not seeing any major revenue generating potential from those companies. And those companies are not generating revenue either. Their revenue generating is less than 50 million. Each one of those quantum computing stocks, their revenues are in the few tens of millions of dollars. They are not even getting to hundreds of millions. So we generally wait till it gets to a decent amount of revenue generation for us to get confident that we are not investing like a venture capital would do, right? Venture capital firms invest in companies that are going to generate revenues 5 years from now. We are taking care of public money, listed stocks. We have to be very cautious. We cannot invest in venture capital like investments. And we are very clear to our investors also that you are not investing in a venture capital fund. You are investing in a listed stock fund. So we will stay away from venture capital type opportunities where revenue generation may be 3-5 years away. And so based on that philosophy, we are following quantum computing, but are not exactly investing in that right now. Sunil, you want to add anything to that?
No, none. That's what I think you put it across perfectly well that every new exciting thing, there's a high risk of failure of that thing. The venture capital gets the reward for taking that risk. Whereas when we are doing a diversified portfolio within the listed company space, what we are trying to do there is that once something comes into a reasonable risk reward framework and enough people that they have supported its listing in the stock market, the future growth potential is what we try and capture in terms of the study. So I think there are a lot of exciting things like quantum computing happening in the world, but each one has a moment. And obviously, the person who took the biggest risk will take the biggest reward. We don't want to be that who's taking the biggest risk because out of the 10 things, 7 may succeed, 3 may fail. Then you have to look at the overall risk reward and not only pick the winner and say, oh, I made such a huge amount of money from that. But the same venture capitalists would have bet on 3 different things and 2 may not have succeeded and 1 may have succeeded. So I think we are in a safer space of the innovative space is what I would say.
Perfect. Thanks, Sunil. Suman, next question, please.
Yes, sir. So another question we have received on operation part. So they're asking what is the initial charges we take to open the account, and what will be the minimum amount to invest in this portfolio?
Yeah, so there are no account opening charges or anything like that. It's totally free. The minimum amount you can invest is 10 lakh rupees. And I think if you write to Suman or contact us at bayfortcapital.com, we will be able to explain you in detail about our fee structure and all that. But it is in the 2.5% per year is our fees that we charge. And that's about it. There are no hidden costs or there are no hidden charges or anything like that. It's a very transparent structure. So I'll stop at that. Suman, next question, please.
Yes. So another question is, as an NRI, am I supposed to wait for the market correction and invest, or would you like invest now in the current market situation?
So I think we are advocating that you should invest in the current market situation because by the time if you wait for 2 months, the stocks may be up another 10%, and then it's difficult to say that you were not willing to invest 10% back and now you have to invest. So I think generally, if you are a first-time investor, then you start slow and then keep adding so that if the market falls, you can still participate. If the market rises, you are happy because you already started. So that's what we recommend. And that's why we have kept a very low minimum ticket size of 10 lakh rupees so that if you want to start small, you can start small and then slowly add in multiples of 1 lakh at any given time that you want. But as such, we don't have a crystal ball to tell you that what will be the exact time to invest, and it is very difficult to find the exact top or the bottom of the market. So I would recommend that if you are already invested, keep investing a little bit. If you are starting, start with, say, you wanted to invest $100 outside India, start with $20, start with $30, and then slowly add the other part over the period of next 6, 12, 18 months, whatever you're comfortable with. Sunil, you want to add anything to that?
No, nothing. I think that he had also started the question saying I'm an NRI. So from investing in BayFort's portfolio, does it make a difference on whether he's an NRI or a domestic
Oh, okay.
resident?
Yeah. So I think an NRI does not have to invest through India. You can invest directly from your US account to the account you will open with interactive brokers with BayFort Capital. So you don't have to the money doesn't pass through India. You don't have to convert to INR either. So it goes directly. And so as such, you don't have any relation to the Indian conversion or Indian rupee or anything like that, or for any taxes. You don't pay any taxes in India either. So yeah, I think that's pretty much it. Sunil, go ahead.
Yeah. Yeah. You can go to the next question.
Yeah, go ahead.
Right. So another question is, as an entry-level investor, so what would be the suggestion to invest through ETF investment? So is it like they should start with the ETF investments first, or directly go with the direct stocks, like how we are offering?
So I think ETFs is a very investment to a broad basket of stocks. It could be 500 stocks if it's S&P 500. It could be smaller if you're going with a sector. If you invest in a sectoral ETF, you have to decide when to get in and out of it. If you invest in a broad index ETF like the S&P 500, you are going to invest in Coca-Cola, you're going to invest in JP Morgan, you are going to invest in General Motors and Ford. What we are trying to say is that those are matured sectors, matured industries, and in a matured country. So we want to avoid that type of investment. For that, India is very good. Why do you want to go to the US and invest in a General Motors or a Ford when you have Maruti, Mahindra, so many options which are much faster growing and better in India? Why do you want to invest in a Citibank when you have better banks in India to invest in, right? So those are the sectors that you will invest in if you go with a broad-based ETF. And what we are saying is that we don't invest in any of those type of sectors at all. And so you will have the best of both the worlds. The traditional sectors where India is better, you get exposure through your India portfolio. And the sectors that are not available in India, the innovation, the disruptive sectors, that you get exposure through our direct stock investment portfolio. So that's how we are trying to say that you can invest. But obviously, every investor has their own preferences, and ETFs are also a good option if you want to invest in a broader market-based portfolio. Sunil, you
Yeah,
want to add
just
anything?
one thing to add here is, see, if you just want the excitement of going outside India, then ETFs will do the job, right? Oh, you want to say that I've gone outside India, global diversification. But as I said in one of my slides there, right, country-wise, the returns have varied from year on year, right? So when you choose an ETFs, right, very hard to build a multi-country portfolio with ETF. Then you have to invest in each country's ETF, or you right then, or you have to give a globally diversified ETF, right? The second point about ETFs, which Ketul mentioned, which I want to expand upon, is that a company makes it to an ETF, which is makes it to an index after it achieves certain market cap, certain free float market cap, certain criteria. It has established itself, and so you will get a normal market return. But the whole idea behind portfolios like BayFort's is to choose these ideas between the venture capital stage and between the mature stage, which is where you hopefully will be able to outperform the index, right? So in going outside India, if you're doing it on your own, then an ETF is an option because just don't want advice, you're just relying on your own thing. But the moment you're going through a managed portfolio of stocks like through BayFort, then clearly that, in my view, is a much better opinion then you're buying your own individual stocks in those countries. So I think that as long as you have advice and somebody is managing your portfolio and changing it according to the evolving dynamics, I think a stock portfolio is always better than an ETF portfolio.
Thank you, Sunil. I think we have time for one last question. So I am quickly selecting the best question from the list, and I will answer that. We have a hard stop at 12:30. So I'm sorry. The other questions, if you can, send us an email on contact us at bayfortcapital.com. We will be more than happy to answer. One of the questions that we are getting is that are we 100% invested in the US only? No, it is not a 100% US portfolio. We are 70% US, 30% around the world. So we make sure that there is enough diversification in the portfolio as well. So I think that was the last one. Sunil, you want to say a last few, closing remarks?
Yeah, so basically, so the idea was in today's call was not just to pitch Bayfort as an option, which of course we would like to do, but the key is that to emphasize that uh, what a mutual fund window which has closed by and large for you to do global diversification. The LRS is given an opportunity through a managed assets portfolio by an experienced fund manager to go outside, and it has to be a critical part of your overall diversification because India will be the fastest growing country in the world for the foreseeable future, but doesn't mean the Indian stock market will be the fastest growing stock market for the foreseeable future. With that point, I want to end it.
Thank you, everyone. Thank you, Sunil, for the wonderful explanation, the time that you have given. We look forward to continuing this every month, and all the participants. We will share a recording also later on, and so we look forward to seeing you next month as well. Till then, have a nice month. Thank you very much.
Thank you, and all
Thank
the
you.
best. Your global investing
Thank
efforts
you.
for
Thank
everybody.
you.
Thank you.